Hello everyone, welcome to Paramasa Masterclass. So today topic is timing the market and why I feel it's a useless activity. Okay, so this is a current state of an investor nowadays. Okay, there's an information overload, very less wisdom nowadays. Business channels, media, they'll keep on confusing you more on what to do with your investments. Black Friday, Black Tuesday, Black Monday, all that stuff. Okay, this is the current state of an investor, and this kind of a confusion always lead to questions like, for example, okay, I'll wait for market to fall, then I'll invest, or you will keep on asking question that what is the right time to enter the market, or people will walk you down, okay, you have missed the bottom, that was the best time to enter the market, you will never get that time again. But we need to ask these questions to ourselves, that whether do we really need this timing? Is it really yielding any returns to our investment? Is it making any difference to our investments? Let's find out. So we'll go with the assumptions first. Okay, we are evaluating the performance of three portfolios for past 93 years, not 10, not 20, not 40, 93 years. Okay, the first portfolio of Mr. Dumber, who only invests at 52-week high level. He has a bad luck of investing every year, okay, when the market at the highest level. Second portfolio, Mr. Smart, who has a knack of investing at 52-week low every year. He's a superhuman. For past 93 years, every year, he's been investing at only 52-week low. Okay. And last is Mr. Dump, who only invests on yearly closing level every year. Okay. He only invests on yearly closing. Whatever the last trading day of the year, he only invests on that. So assumptions are that since it's a 93-year-old data, okay, so we have done this calculation that once in a year they will invest. All three of them, once in a year they'll invest. Okay, Mr. Dumber, he will only invest at 52-week high every year. Mr. Smart, he will only invest at 52-week low level every year. And Mr. Dump, he will only invest whatever the last year closing price is. Okay, these are the three strategies being followed. So this is basically what happened in a normal investor thing. They either invest in a DCA mode, or they try to find the best level to enter. And there are some people who entered 52-week high level. So we have made it static. Let's see what will the result will be in the past 93 year of data. Also, they'll be putting the static amount of 1,000 every year as per their portfolio strategy. Okay, and they'll be investing every 1,000 they're buying into units of S&P 500. So the logic is, if interest level is as per the strategy is 100. Okay, 100 means, for example, 100 is the lowest level, so Mr. Smart will invest at that level, or Mr. 100 is the highest level, Mr. Number will invest on that. So accordingly, so if the interest level is as per the strategy is 100, they will buy 10 units, and if it is 2,000, for example, they'll buy 0.50. So the logic is, since it's 1,000 rupees is a static INR they're putting every month. So as per the level of the index, they will accordingly the units they will accumulate. Okay, so the lower the price, higher the unit. As simple as that. Right. So this is the S&P 500 index value for past 93 years. This is like red bracket, red bar is for Mr. Dumber, green is for Mr. Smart, orange is for Mr. Dumb. So that's how the color coordination has been done. As you have, it's mentioned here also. Okay, just to relate to that. Okay, so for example, 1928, the highest level was 23.35, the lowest level was 16.95, and the year closing was 23.35. Accordingly, the year high, low, and closing is for the past 93 years. Right. Now, based on that, all the three individuals have bought the units. So, for example, again, 1928, the highest level, 41 units bought. Mr. Smart, because he's Mr. Smart, the lowest level, he bought 58. And whatever the year closing was, accordingly the same, so bought 41. So just like that, for example, in 1932, for example, we take the value. Okay, the highest value he bought 107 because he bought it at the high price. He got less units. Mr. Smart 227, double of that. He bought at the lowest level, and whatever the closing price was, Mr. Dump has bought 145. So accordingly, they have accumulated the units, right? So accordingly, based on every year 1,000, 1,000, 1,000, they have accumulated the units. Okay, so the lower the price, the higher the units, and the higher the price, lower the units, right? So what are the findings? Mr. Dumber have bought total in last 90, total invested capital 93,000. He has bought total units of 2073, right? Right. And based on the total 2021 closing, 94,000 is the total value, right? Because every unit, because we are buying index, as you have seen, we are buying index, right? So the 2020 YTD closing right now we have put this much. So based on that, we have bought the price. So because they have buying directly from the index. So every unit has an index price, right? So whatever the index they have accumulated in 2021, the value of whatever the index they have accumulated, like for example, 2000 in his case. So 2705 is into this one because they are buying directly from the index, right? So he has got total 2073 units, total portfolio value 94 lakhs 67,000. Wow, right? Now, Mr. Smart, because he is Mr. Smart, he bought 50% more units, right? 50% more units because he is Mr. Smart, right? He bought it at always at the lowest level. He bought it always at the highest level. Look at the difference. Look at the difference, right? It's 50,000. It's 50% more. 50% more, right? So the point here is that. So the point here is. So this is Mr. Smart. He has bought 50% more units, right? Because he is Mr. Smart. And what our Mr. Dumb has done? Okay, what he has done. So yes. So Mr. Dumb, okay, he has bought 2412 units at the average closing, and his port value is 1 crore 10 lakhs. So if you can see, not a major difference. 1 crore 10 lakhs, 1 crore 37 lakhs, right? Okay, he has bought at every year closing level. He doesn't know high, he doesn't know low. He bought every year at the year end closing price, right? Mr. Smart, because he is Mr. Smart, he have bought to 3,000 units every year closing price, right? Now, we will not go with the cumulative portfolio value here because every year they're investing. The right way of looking at the returns is XIR returns because every year they're investing. So let's look at the XIR returns. 7.18% for Mr. Dumbo. Okay. We will find out whether it's good, bad, or not. Mr. Dumb, 7.39. This is 93 years XIR returns we're talking about. Let's find out Mr. Smart, what Mr. Smart has done. 7.68. So can you see, this is striking, this is shocking, that in past 93 years, every year, he is investing at the highest point of the index. He is investing at the lowest point of the index. He is investing at whatever the last closing price is in a DCA manner, dollar cost averaging. In spite of all that, look at the XIR returns. Is it, the difference is not earth shattering. Okay, it's hardly a difference. 7.18, 7.39, 7.68. Mr. Smart, all his research, all his timing, everything of investing at the lowest level every year for past 93 years, he is just 0 point. He is just 0.28 basis point ahead than Mr. Dow. Just 0.8. All his efforts, all his energy, all his skills of investing the money at the lowest point of every year, he is just 0. He's just 0.2229% basis point ahead. And our guy here, who has a knack of investing every year at the highest point, not that far down. It is not like he's at 4% to or whatever. Just a look minor difference in comparison to Mr. Dow. Shocking, really shocking. And please don't get on this difference here. Need to understand this is a 93 years old data. If it's a 30-year-old data, for example, the difference will be even much lesser. Because, for example, if we compare this to the two extremes, if we do the same XI returns on 30-year period, the difference will be not this much, the cumulative one. It will be maybe 20, 10, 20, 25% more. Okay, 10, 15%, whatever. I mean, depending on that. Look at the difference, 7.18, 7.68. 0.5 basis point every year. Because it's a 93-year data, that's a cumulative number is little higher. But this is not a concern. This is not a right way of looking at it. This is a right way of looking at it. Every year they invest. Really shocking. Right? So what are the takeaways? The takeaways is simple. Time in the market is more important than timing in the market. Because these investments were there in the market, that's the reason they have given a cumulative return. That's much important. Constant selling and buying increase your tax bill, and also your time is also get wasted. See, understand, time has a value. Your constant buying, selling increase your tax bill, your LTCG tax of 10%, short-term capital gain taxation, then the brokerage fee, then the other security taxes. Right now, most of the do-it-yourself investors maybe have the smaller base. So that's the reason these taxes are not hurting you. But as you grow older, as your numbers get bigger, this will hurt. This will hurt. For example, if I tell you about my portfolio, the LTCG taxation of 10% of my portfolio is 2 times than my initial capital when I started 30 years back. So it hurts. It hurts. Constant selling and buying. It increases your tax bill and reduces your returns. And also, when you're out of the market, you lose on dividends. Okay, because when you're in the market, when you're invested in the stock, you get dividends, regular dividends. You lose on that, then you have a reinvestment risk. Okay, then when you will be investing again at what price? Also, you will further lose if the market goes up, because your money is out of the market. There are a lot of people who are sitting since January, since November, December, waiting for market to fall, and markets still have giving a roaring returns at YTD. They have lose out on that capital gain forever. Also, you'll be stuck with the loop of timing again. When to enter, when to buy again. You will stuck with that. Also, whether you buy at highest level, lowest point, or any point, it does not matter. It does not matter. What matters is the consistency of your investment and the amount you're putting in those investments with your human capital. The bigger the amounts, the better. That's some key thing. Timing and creating that alpha out of buying high, sell low doesn't matter in long periods of time. If you look at India, same concept, same logic. If I use the same metrics on Indian market, it's the same thing. From 1980s, 1990, 1,000 points. Whatever bad has happened in past so many years of Indian Sensex history. Okay, still the market's roaring return, 1,000. Okay, 10,000, 20,000, 30,000, 50,000. All the bad things that were supposed to happen has happened. Scams, terrorist attacks, blast, political issues, budget issues, global crashes, everything. Market keep on going, keep on going, keep on. That's what the beauty of equity markets is. Please, 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 your tracking doesn't make any difference to the market. So at the end, Simple tips to do-it-yourself investors are very simple. Focus on your earning human capital. That's the biggest tool to build a huge fortune, and put that money put into the equity markets. Let the management, the companies do the work for you. You have to focus only on your earnings and human capital. Make those checks which you're putting every month bigger. Use your free time to hone your skills or work on your hobbies, but don't waste your time in market. It's not worth it. Okay. Last but not the least, just relax and enjoy your life. Don't waste that in front of the stock ticker or what will happen, what not will happen. The 93 years of history is shouting for that. Your timing, your efforts, your knowledge doesn't make any difference to market and stocks. You have a zero impact on the markets, right? Thank you for your time, and all the best.